Let's talk a little bit about this. Jeff Duncan of Duncan Financial Management is joining us this morning. So, Jeff, the deficit situation being what it is, how does that change your strategy as an investor?
Well, definitely when people are holding treasuries, and a lot of people have been getting into treasuries. I mean, there's been a flood of investors buying treasuries. A lot of people in 401ks have been putting their money in the bonds. And as we've seen, interest rates in a 10-year treasury have been creeping up. We're at 3.72%. Obviously, the costs of the government are going to start increasing as interest rates go up. At some point, if we get over that 4% level on the 10-year treasury, that's going to have a significant effect on people's bond portfolios when it comes to prices. And many people have felt during these uncertain times that this was the safe haven to be in, was the bond funds. And when they start to open their statements and see that they're actually losing money, then we have a mass exodus out of bond funds. That's going to have a greater effect on what the federal government is paying in interest rates, which is going to continue to increase the deficit.
Well, let's talk a little bit about that. Yesterday, we had an auction for a 10-year note that went fairly well. Today, we have another auction in treasuries for a 30-year bond. Again, as you mentioned, there's been healthy demand with these auctions of late. When do you think is the tipping point where investors really say, okay, we've had enough of this, and we don't see those auctions as successful anymore?
Well, I think once you get that 10-year treasury, as the Fed's going to start talking about, is when are they going to exit buying treasuries? When are they going to exit buying agencies, getting out of the market, and at some point start raising the discount rate, the Fed funds rate? That's when you're going to start to see people move out. Once they start moving out, it's a very small door if a lot of people into these bond funds and thinking that these bond funds do not lose money, when, as we know, as interest rates go up, the value of those bonds go down. So it could have a significant impact on investors.
So do you think we're in a bubble right now? Sometimes you don't know you're in a bubble until it bursts, but are we in a treasury bubble at this point?
I would say so. Over the course of the next year or two, we will find out that it was a bubble. The treasuries were a safe haven during an uncertain time as we went through some significant market declines. A lot of people fell into those. Most people that are unintelligent investors when it comes to their 401k put the majority of their money into these bond funds. And as these auctions, eventually at some point, the people that are bidding on these auctions are going to want higher interest rates for the risk that they're taking because of the deficits as we've seen in Greece.
Well, let's talk, just a final quick question here. What about the crowding out effect? What about the fact that Uncle Sam is offering so much debt to the market? What does that mean for corporate debt that's being issued, and how should we view corporate debt at this time?
Well, corporate debt, obviously the debt that's being issued has been a much higher interest rate, but a lot of the corporate debt during the uncertainty was somehow backed by the federal government. As they exit those programs too, it's going to have a significant effect on corporate debt. And you've noticed that a lot of corporations are issuing as much debt as they can in this environment. And as we go along here, these corporations are going to have to issue more debt at higher interest rates. But a lot of companies, especially in the S&P 500 right now, are flush with cash, and they're looking for buying opportunities.
All right, Jeff, thank you very much. We'll be back to Jeff in just a little bit. Citigroup, we're going to talk a little bit more about this with Jeff Duncan of Duncan Financial Management. Jeff, there's an article in the Washington Post today that talks a little bit about China by David Ignatius, and this is what he says. He says, the question isn't whether the Chinese economy will change, but how. How do you think China's economy is going to change?
Well, you have so many people, and you just mentioned about food prices, that we're going to continue to export a lot of food to the United States to China. And how this is going to affect is that they're going to need higher wages, with China already stimulating the economy that worked right away, unlike the United States. China is really going to have to pull back the stimulus at some point, and they've started doing that, but at some point they need to increase or decrease the stimulus package to keep inflation in check, as people over there start to see what it's like to have abundant food, have nice housing, and they're building like crazy. So that obviously means that prices are going to go up. So at some point, they're going to need a significant pullback in prices.
When do you think that would be?
Well, as soon as possible. They've already begun, increasing interest rates, but I think they're really going to have to step it up in 2010 to decrease the demand that's being pulled on their economy. But I think this is really going to hit about the middle of summer when they see significant price increases as the overall population of China is going to start demanding more food, more goods, more services. And as we've seen in the past with the United States, that's a tough bowl to push away from people once it gets going.
You know, there's been so much optimism over China's economy and how it can lead a global economic recovery. And the Washington Post brought up this interesting point about the stimulus that you say has been effective, and many people agree with you. But this was a concern that was brought up in this article that there's a larger problem of questionable loans on the balance sheets of China because of this stimulus. Are you concerned about that? How concerned are you about that dimension of the stimulus and what that might mean for this economy?
Well, that's no surprise that you're going to have some questionable loans in any economy that's growing like they've been growing. Obviously, they want goods and services like we have in the United States. So there are going to be instances that we hear about in China that there has been lending activity that was very borderline at best. This will have to flush out, but that's in any economy that's growing, that's stimulating the economy. There's a lot of cash on the sidelines, a lot of cash that people want to get to. So they're going to fudge the numbers in order to get the loan to continue to build and stimulate the economy. So as time goes on in 2010, we'll hear about these, but the Chinese really need to pull back the throttle at this point before they overstimulate and really have significant price increases. And if the U.S. economy starts increasing, then we're going to demand more of their goods, which is going to raise prices there in China.
Okay, so then what's the right play here? Is it looking at companies exposed to China? Would it be like looking at a Baidu, for example? Is it looking at maybe currency plays to be able to capitalize off of what is potentially an overheating of this economy? How do you work this market?
Well, I think if you're buying U.S. international companies like your Coca-Colas, your John Deeres, your Caterpillars that have the international exposure, especially in China, I think that is a good play. A lot of these companies are significantly off their 52-week or their all-time highs. And this, if you have international growth, especially in Asia, not in Asia, but also India, that you can see significant price increases as we go along in 2010, and especially the U.S. economy is starting to pick up a little bit. But as time goes on, the U.S. economy will start picking up, and then you'll have some nice growth in the United States and in China and in India, and these international companies that have these global footprints around the world could see some significant profits moving forward, which would increase the value of the stocks.
Sure, we saw that with McDonald's earlier this week. Absolutely,
yes.
Jeff. Jeff, thank you very
example.
much. Back to you in just about 10 minutes. We'll talk a little bit about Citigroup. In the meantime,